When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone, and welcome to MacroEdge Radio, a special edition, Friday, November 15th, 2024. This is John Galt speaking, and today, special guest Amy Nixon will be joining the program to discuss economics, the AirBNBust update, and more, because the rate shock we have witnessed in our markets is a sight to behold. And really, in all honesty, I don't think anyone can underestimate what the damage has been done to the sudden rise in rates. And when I say sudden, I'm talking an acceleration that the Fed did not anticipate. But if one were to look to history, you would see that. It's an amazing thing to wish one thing, saying, okay, we hope this brings rates down, which is what the Fed was hoping. It would pressure the markets to bring rates back into reality. Unfortunately, it has not. And what is happening now is we're witnessing the bond vigilantes maybe, possibly, rising from the dead and reminding everyone that the cyclical nature of bond, bull, and bear markets is nothing to play around with. And once those take hold, all hell can break loose in very, very short order. As we await Amy to join us, let me fill everybody in. We prefer to ask questions on the air, but we try to moderate it because we don't like over talk. We don't like cross talk. We don't like a million people talking over everyone. So please understand, we try to select questions for our guests as things are progressing through the show, but we don't like a cacophony, and that's what makes it a little bit different as far as how the X spaces are managed on MacroEdge. We believe in getting as much information out as possible, and what we try to do is make sure everyone gets their shot as much as possible within the time allotted by our guests. And joining us now is Amy Nixon. Amy, good afternoon. How are you doing? And welcome to MacroEdge Radio.
I'm good. How are you guys?
We are doing great. We are doing fantastic. And as I always like to do when I start the program off, for those of you who are not familiar with you, introduce yourself to our audience. Tell us a little bit about how to get a hold of your writings and information besides Twitter and watching Fox Business. Let everyone know where you come from and what it's all about.
I'm Amy Nixon, and I live in the Dallas suburbs, and I primarily focus on the Dallas-Fort Worth housing market. I really only am on Twitter, actually, or X, and so just my Twitter handle, which you'll see on here, and then I do appear pretty regularly on Fox Business as well. And then on various podcasts as they come up and my schedule allows. But I don't have my own YouTube channel or any of that. A lot of people are asking. Haven't gotten around quite to that yet. Part of the reason why is because I'm a mom with 3 kids. One of them's actually home today, sick. So if I have to mute myself, it's because somebody's vomiting in the background.
Oh my God. Sorry to hear that. That's okay. I woke up with a toothache again this morning. So if I sound like Elmer Fudd, I apologize in advance.
That's all right.
Well, let's start the ball rolling. And I'm going to go right back to the big deal, because there were so many people that for some reason attacked you, and I never understood this, for the phrase AirBNBust. But there is a reality to the decline in short-term rental activity and the viability of the business model, especially as we go from the post-large inflation or major inflationary environment to just a settled higher rate of inflation environment, which people don't seem to understand. The inflation is now embedded into the system. It's not come out yet. We haven't had deflation to bring prices back to pre-pandemic levels. Where are we at with the Airbnb bust?
So, originally the premise of that concept was Airbnbs never existed before in a recession. I mean, they were founded in the wake of the '08 financial crisis, and outside of a very brief blip in 2020, which was immediately met with obscene amounts of stimulus, particularly towards real estate, there was never really a recession at all to test this how this business model would perform in a recessionary environment. So back when I came up with the theory in, I think it was 2022 that that tweet came out, and there was a subsequent pretty strong tech stock market correction that followed when the Fed started hiking rates. And Airbnb stock did drop significantly during that entire correction period as well. But the company continued to do okay, just as the economy continued to do, in quotes, okay, because of all the fiscal stimulus that we continued to pump out, and because there was still that residual, just leftover stimulus from the extremes that we put in through the pandemic, that sort of enabled the economy to function significantly better than a lot of people, than most economists anticipated. We did not have a recession in 2020, or officially declared recession in 22, 23. And this year, although I do feel like we've quasi been in recession since spring, it's not been an official, again, it's not been an official announced recession. My personal, you know, reasoning behind that is that I don't think the CPI is accurately captured inflation. I think it's been at a higher level than what CPI is generally captured. So our GDP, even though it's come in as positive, if you actually looked at our real growth based on how we calculate inflation, like in the 1970s, we would be, what we have now would be considered more of like a stagflation. So, and we have seen that just in the last several months with Airbnb's, their latest earnings they missed. It was a slight miss, but it was still a miss. Um, and we're starting to see that finally, after all of these years of stimulus, a significant slowdown in demand of consumers for vacations, particularly the bottom 80% of the country. So, and that is with unemployment still at fairly historically low levels, although it is also rising. So I really think the next 12 months are going to be a big test and challenge for Airbnb and for Airbnb hosts as well, because the other piece of sort of this stagflation type backdrop is the interest rates. These long foretold dropping interest rates, it's starting to look like those are not going to be falling, at least not falling significantly the way people had prior anticipated. And there's a lot of people sitting on floating rate debt that have these investment rental properties who really aren't going to be well positioned if they're not able to refinance. And again, that's one of those things that for a year or two can look okay in the general economy, but as time ticks and they are cash flow negative and they are needing to refinance and they cannot, it is just sort of something that brews underneath the surface.
100% agree with that. We're seeing, I'm going to get your take on short-term rentals in the Dallas-Fort Worth area, because I can speak for the west coast of Florida and what we're witnessing here. And I'll state that pre-hurricane, folks. After the hurricanes, the model's in a lot of trouble. But before the hurricanes, we were witnessing a lot of rebellion against the short-term rental market, especially from smaller communities that had had enough of the parties, and not to mention a lot of people potentially committing fraud by filing for homestead insurance versus commercial renters insurance, which is what they should have, since it is a commercial enterprise being exercised in a residential location. I don't see a big demand for STRs should this stagflationary environment exist more than 12 more months, because the cost structure of owning the home is starting to overwhelm a lot of these younger millionaires who went to seminars. Are you seeing the same thing in Dallas-Fort Worth?
There's been a huge slowdown in new entrants to the market, or sort of new hosts. And I think it's for the exact reasons that you said. It just doesn't pencil in right now. The prices are too high at these interest rates to have any sort of cash flow realistically, even if they are able to get full occupancy, which again, if you're buying some random house in a suburban area of Dallas, and now you're running the risk of the neighborhood HOA, whatever, the local zoning people just saying, hey, we decided we're going to ban short-term rentals in this area, because that's been happening a lot in the last couple of years as well. So you've got that risk up front. Then you've got the risk of just the market's pretty saturated, and the demand in general for rentals in a suburban neighborhood has slowed significantly since we kind of come out of this post-pandemic boom. Um, and these are not, if you're just buying a random house in a random area, that's not somewhere where in average vacation demand environment, you're going to be getting a lot of bookings. And I think it's confusing for a lot of people because Airbnb, they're still reporting record levels of revenue. Their profits are good. As a company, it appears that their growth is slowed, but it's still okay. And a large part of the reason of that is because like I said, the top 20% of the country have honestly had what I consider to be what may be a fairly and I won't say permanent because we haven't had a recession yet, but what's up to this point been a significant shift that's been permanent to this point, which is they are taking more vacations than ever. They are taking more expensive vacations than ever. That's like the top quarter of the country. But the middle and the bottom, that has dropped off significantly. Personal savings from COVID are gone for that, the median person in America. They're pulling back on vacations, travel. You're seeing that, you just saw the Spirit Airlines bankruptcy. Um, in terms of volume overall, you're going to see a drop. But in terms of spend, it's holding up because, again, that top cohort of the country is taking more trips than they ever have. They're getting more luxury things than they ever have. And they're sort of holding up the entire business model right now. Like it's sort of just like if Airbnb normally had their earnings distributed all across, the 100 percentile of median incomes in the country, suddenly more of their earnings are coming from that top group. But it doesn't matter to them. It doesn't matter to their balance sheet. It doesn't matter to what they report to their investors. But it does matter to hosts. It does matter to hosts, particularly hosts that have just kind of average properties that aren't luxury, that aren't in interesting places to vacation at. Those are the properties and those are the hosts where you're going to start to see sort of that they're on that TikTok time clock for, am I going to get enough occupancy, and am I going to be able to refinance this sucker, and am I going to be able to afford insurance and tax increases, which, like you were saying before, like areas like Florida with the hurricanes, areas in Texas has had huge insurance and property tax increases in the last couple of years. So I think, depending on how skilled the host was as an investor in terms of underwriting space into that property for those increases of all these costs, you're going to start to see a lot of them sort of have to make a decision. Hey, do I sell this thing and just take the equity out that I earned, or not earned, gained, or do I sit on it while it loses money every month and just sort of hope for, I don't know what they're hoping for, honestly, because you're never going to get a better environment than you got in the last 3 years.
I think the trap that they've built for themselves is that when this original seminar model was presented to the younger buyers, and I'm saying that not to criticize Gen Z, but it was characterized as a get-rich-quick scheme by some of the seminars. Hey, you can buy homes and rent them out as STRs, and in Florida during on-season, rightfully so, you could make as much as $3,000 to $4,000 a week in certain locations. And if it ever slowed down, you simply flip the home. Well, it's very hard to flip a home if we start approaching 7.5%, 8% mortgages again, correct?
Yes, it is. It is going to be a very difficult environment. I think in general, real estate is not well positioned right now for what I think is coming in 25. There's sort of been kind of this blind hope that we're in a different place in our long-term debt cycle than we actually are. And for the last 25 years, all we've known really is lower and lower Fed funds rates and lower mortgage rates. And we have exited that pattern. And until, I'm not convinced that we're going back to it at all in the next decade. Um, I think that we're going to settle out at a higher low for mortgage rates, which means, maybe we will see rates come down in 25, but maybe the new, what used to be 3 or 4% is now going to be 5 to 6. And I just don't know how many real estate investors are positioned with their debt for that reality. It doesn't mean that everybody's it's gonna be like a Armageddon, But I think there's a lot of people, like you said, particularly people who listen to seminars and just sort of got this frenzy late in the cycle, late in the game. They're not positioned for that kind of a real estate environment. It's a really challenging environment to operate in, to the point where even the big players have been having to move pieces around and struggle, honestly, through the last 18 months since the rates were hiked. And it's still there's still, they say there's an 18-month lag. So the extent of, those final hikes still probably hasn't even filtered all the way through the system, even though we already started cuts. So I definitely, it's not going to be smooth sailing in real estate at all in 2025. And this, sort of golden idea that, I don't know whether it was that lower rates would save us or this Trump election would save us. None of this stuff is going to save us. Especially, I mean, we already just had Powell. I think, it's been like a week since the election. Powell came out and he said, "Hey, we can't take hiking off the table in 2025. Like, what in the world? Like, this is nothing he has said at all in the last, 6 months. And then all of a sudden he comes out with that one. Why would he say that? What is he seeing in the data that would prompt him to say that? I mean, I know what he's seen, but um, yeah, I just don't know that right now very many real estate investors are positioned for that.
I agree, and there's the information we're seeing is the same as what you're seeing, and a lot of these investors were not schooled, quote unquote, seminar investors were not schooled on the maintenance costs and upkeep that's required for a property. They just were under the impression you hire a cleaning service, they clean your house, and you proceed on. Things break. It's just like an automobile. Things break. Things need repairing. That's an allotment for expense a lot of people didn't incorporate into their models, especially when they bought older homes. And now they have a new wave of competitors. And there's an upcoming article. If you subscribe to macroedge.net/ozone, check it out for a 2-week free trial. In tonight's Red Eye, where I look at some of the stocks that are positioned. For those who are wondering, I put up a chart of Airbnb in that. And I posted it up on the thread. They've never reattained their IPO high. They are still far below it. And at this point in time, with the consumer pulling back and the competition from the Marriott and Hyatt vacation clubs, I would, personally speaking, rather stay at a Hyatt or a Marriott versus Joe Schmo's house in a particular location. What about yourself?
Well, yeah, I mean, like I said, I think especially in the next year, and now there's this other weird variable too with this whole Trump pump, which I will wait and see how long, how much legs this thing has. But if we have this wealth effect piece coming in, once again, that is going to pour more fuel on the fire of this divergence between that like top 20% of the country and bottom 80%. So if you are positioned as in real estate investment right now, you absolutely want to be in luxury. And you absolutely do not want to be Joe from internet, class 101 who bought some rundown little ranch house in some suburb and thought, I'm just going to rent this out. You're going to find that your customer base and that other group is dwindling because those are the people that are being affected by layoffs, which again continue to increase. Those are the people that are being affected the most by the increased carrying costs of inflation across their entire budget. If they still have their job, they're paying more for groceries, they're paying more for insurance, they're cutting money from somewhere in their budget, and vacation is not like one of the top discretionary items that people are going to start cutting if they have to. So anybody that it used to be, you could just sort of buy, like throw a dart at a dartboard and buy any piece of real estate, and you didn't have to really think that hard about it or plan or carefully consider, is this actually a good investment or not? And it would just sort of magically go up because we were in this environment where interest rates just magically went down. And that era is over. It's over. And I think, honestly, I think the entire real estate world hasn't even digested that fully. I still talk to people who are like, oh, just wait, like we'll be back below 3% mortgage rates in X amount of time. And I really am not convinced that's going to happen. I would be really, really surprised if we saw a 3 handle again, honestly, in the next like 2 years. I mean, that's just my personal take, is I think that rates are going to land higher than people expect. Now, it doesn't mean that I think they're going to be, I don't know that they're necessarily going to go higher. I'm not taking that off the table either, but I think the new lows will be higher lows, if that makes sense.
It absolutely does. I'm one of the firm believers that bond markets perform in a similar cyclical fashion. And a lot of people forget the boom that occurred after 1982 when the bond bear market ended and the bond bull market began. I believe in the last 4 years, we've hit the end of the bond bull market. And this end never ends smoothly. It never ends with a set rate. It never ends with a set target, but usually has violent moves up and down. And at this point in time, with the disinversion of the threes, tens on the horizon, along with the Fed, that sounds like they're going to hesitate about cutting in the next couple of months or possibly pausing after next month. If that were to occur, there's only one way direction for mortgage rates and bond rates, and that's going to be with higher yields and higher credit expense or cost of money for the average consumer.
Yeah, I mean, one thing that generally the Fed doesn't like to sort of ping pong back and forth with policy. So they have entered a cutting cycle. And that's where we're at now. So for the next, I would say probably at least 6 months, really the only things they're going to be looking at are either another cut or a pause. After a certain period of time, if inflation starts ripping to the upside again to a point where it's highly concerning, which again, I don't really know that they have a great threshold for that, because I thought it was highly concerning in 2021, a long time before they did and started the actual hike cycle that they did. But to whatever point that they consider it to be highly concerning, I think it would be happening for a while, and they would be sort of pausing and wait and see type thing before they would actually go back and embark on another hiking cycle. Like, we are in a cutting cycle now. So I would say in the next 6 months, expect them to either cut or say, oh, we're going to pause. Um, but that doesn't mean that there couldn't be another future hiking cycle, which, Paul already weirdly hinted at. The hikes are not going to be taken off the table. And as you're saying, and you were talking about the bond market, like, even if we are in a cutting cycle, if the bond market doesn't like what it sees in the economy and they don't agree with what the Fed is doing in terms of the cuts, then they're going to make their own moves. And mortgage rates are going to, as we saw, the mortgage rates went up after that first 50 basis point cut in September. And they always say the bond market is the smart money. People aren't going to buy bonds that they don't think are going to outperform inflation. They're just not going to do it. So the market's going to move to where it needs to go, to what it anticipates the economy is going to give it. And that's going to happen regardless of what the Fed does or doesn't do. So yeah, it's going to be I think 2025 is going to be a really interesting year with sort of what the Fed does, what mortgage rates do. And, now we've got a new leader in charge too, who I think is going to be unhappy with higher rates. So that's going to be a whole other interesting piece that we'll see how that unfolds as well.
I agree. And I think we're going to have a sudden miraculous parting of the season revelation of, oh, we made a mistake with the data. We have to revise it come February, whether the new administration likes it or not. And there is a bureaucracy that will fight them tooth and nail all along the way. So there is a fear that, quote unquote, the real data will seep through and it will be far worse than what we thought, whereas you and I think it was bad already this year, and how it evolves. Just to start up on the stagflation, which is something I believe we're entering into, it's been 50 years since we had a stagflationary cycle, and the majority of the individuals in the Fed and the economists on Wall Street, et cetera, have never experienced such a cycle. Do you feel, as I do, that the tools and the ideas to fight stagflation are not in place due to the lack of experience or the belief that this is a modern era that can't happen again? And that is going to be a problem that might prolong something which could be cured with higher for longer in the right environment.
Well, I mean, the number one tool that we're lacking to fight stagflation is the inability to face reality and complete denial that we are actually in it. Part of it has to do with just, the way they keep changing the way they calculate CPI, like I just said earlier. Um, and then part of it has to do with the way that we've sort of been delivering the employment data over the last several months. Then all of a sudden you get this bomb drop of 800,000 revisions in the middle of summer. Um, do we even have accurate data as far as inflation is concerned and as far as employment is concerned? Those are two things that are important in determining whether or not we're in stagflation. But certainly with the data that we do have, you can make a case that we are actually legitimately, as far as all the data confirms, in stagflation in certain sectors of the economy, and housing is absolutely one of those. Real estate has been in stagflation since the Fed started hiking. Shelter is, I think, one of the most stubborn, persistent pieces of inflation. We're still running 5% year over year, and the Fed started cutting again with it at 5% year over year. And that was happening alongside record low mortgage applications, record low existing home sales. Now we're starting to see hits to new home sales as well, and massive layoffs across so many industries. You've seen massive layoffs in Zillows and the Redfins, and pretty much every mortgage broker. They've been laying off heavily since 2022. So if you're looking at recessionary data in terms of activity and persistent inflation in terms of shelter costs, that shelter stagflation or shelter inflation component keeping going up, then housing is absolutely, real estate in general absolutely is stuck in a stagflation. But they're not right now willing to expand it out to the entire economy and say that it's happening in the entire economy, because there's still pockets of the economy where we don't have or unemployment overall, they say, is not high enough to consider it official, stagflation. And like I said, GDP is still squeaking out positive because of some of the areas where there's a lot of government spend, where it's enough to pull us up to a place where they say, oh, we're growing. We're not stagnant. This is not stagflation. But in a lot of ways, it's stagflation in like the real parts of the economy that actually matter. And then it's growth in like sort of these weird bogus areas that nobody cares about. um, and areas where the government's just sort of spending a ton of money adding these weird jobs to their rosters that nobody really knows what these jobs are or what they do. But it's been enough to buoy our employment levels for them to declare that we're not in stagflation. But it seems to me more and more like we're snowballing towards just having been in sectors of stagflation like real estate, and moving towards the entire economy in a stagflation. And yeah, I think it's going to be really tough because, like you said, I don't think that we're really prepared for that. We haven't seen it since the 1970s. Most of the people around today haven't lived through it, or they were very young when it happened. So it's going to be very interesting to see sort of how we navigate through just kind of sluggish growth and unemployment a little bit higher than we like, and an economy that's just kind of struggling along.
I agree. The bifurcation of the economy is the biggest issue facing the new administration, plus the dismantling of a regulatory state, which has created terrifying burdens on every aspect of the economy. One of the things that I noticed, because I had discussed this with you online, the stagflationary aspect of things and how people are trying now to claw back from vendors and others price increases that were granted during the rampant inflation of a year and a half ago. Most people don't remember when Ronald Reagan came to office, the January inflation rate during his inauguration was 11.8%, and the annual rate for 1981 was 10.3%. If we suddenly surge back up towards 5%, which is probably a more realistic number measuring inflation for the consumer, not PCE or the reported inflation, it's going to have a major impact on spending, which will impact not just housing, but automotive, which we're starting to see the layoffs, and other big ticket items. When you look at the macro picture, what do you perceive is going to be the problem as credit becomes more restrictive into slower growth for that bottom 80%?
You know, the complicated piece that I have trouble sort of putting in all this is that wealth effect piece, because like right now everything is still ripping from this Trump pump. So as long as there is growth in terms of, I don't know if you'd call it income, wealth, whatever you want to call it, but access to money that people have, sort of buoying things up, then you will continue to see spending, even if the wages are lagging, which they have been lagging for at least the last, probably, I mean, they've lagged overall since the pandemic, although they have risen. They haven't risen to the extent of the inflation. But again, if you've got your median consumer living in a house that's locked in with a 3% mortgage rate, they're going to have a little bit of wiggle room in their spending. If their 401k is going up, if the value of their house is going up, they're going to go pull a HELOC, whatever they have to do. Most people will exhaust all means of credit that they have available to them first before they lower their standard of living. But we've already seen that happen so much over the last year and a half, and I feel like we're kind of on fumes when it comes to what's left available for a lot of that bottom 75th percentile. So going into the next year, it's going to continue to be a struggle for that median worker. And I think even more so because, like I said, as you see people start to sort of exhaust out and burn out, that will sort of compound over time as layoffs continue to roll on, as you suddenly have people now who've been out of work for 6 months or a year instead of out of work for 2 months or whatever. As it builds, it tends to build more significantly into a pain point. And that's also, like you said, happening alongside price increases across the board on all of their consumer items that they buy. Even if, like you said, inflation's at 5%, that's 5% that all of their expenses are going up and not their wages. We saw in the last report that wage growth is started to cool. So, some of that could maybe be offset by, like I said, these weird Trump pump wealth effect stock market. But that's also going to come to a head if and when the Fed is forced to pause and or hike again. I think that's where you're going to see the stock market, who's right now, PE ratios and valuations are just completely in la la land. What brings that back is if the Fed has to pause or hike. That is sort of where the stock market is going to have its little aha moment, like it did in 2022, where sort of all of those rate sensitive stocks, which real estate and tech are the two biggest ones, those are going to have their wake up call. Like, oh, wait a second, we aren't positioned for higher rates. And that's going to be another, if inflation comes in waves like it did in the 70s, we're going to have another sort of cyclical bear market move across everything. And it's going to be interesting to see how that would work out, again, because we're still going to have this, like I said, that backdrop of how much is all this other stuff going to pump first. Because as long as that everything's pumping first, you're going to see people spending that sort of pretend money that they don't have, or that's like on a number sheet they see that they have that money, but it's all just, they haven't sold any of the assets, they haven't actualized any of those gains. Yeah,
I'm with you on this because I think that the speculative gains from the stock market have given some people a sense of expanded wealth. But in reality, a lot, like you said, a lot of people are keeping up with the Joneses via credit. And that's not a healthy environment, and it invites a credit bubble, which is what I think the bond market is sniffing out. When you look at the big picture, we had an era where another Fed, a famous Fed chairman, made the mistake of cutting rates right before an election because he thought inflation was tamed. Yes, as some people say, that's my personal jihad, and that's Paul Volcker. He cut rates in 1980 in the summer, and immediately after that, inflation shot up to 15%. So if we see an inflationary burst in January, February, and March, which I expect, just as you might, uh, I don't think the Fed really has much of a choice but to announce a pause or quote unquote strategic review or some other instrument, which is severely going to impair growth in the first half of next year.
Yes, I mean, if you follow Trueflation, they've already shown the inflation is creeping back up, and it has been for a couple months now. They're posting it closer to 3, and your current BLS CPI is lower than that right now. But they're gonna probably Trueflation was the lead in 2021. They were the leading indicator on that, and I think again they're going to be leading here. So the official government data is going to start picking up on this new burst of inflation probably in about 3 to 6 months. But my concern, that's always been my concern, is at what point do they consider it problematic inflation? Do they consider 3% a problem? Is that going to be enough for them to say, oh gosh, we have to pivot our policy direction now from a cut to a pause to a hike? Like, at what threshold does it have to breach for them to say, oh, we need to be hiking again? Because what I suspect that they're going to do is in the threes, we're just going to get words and not policy, like things like transitory, or we'll just have to watch this. We're keeping our eye on the data, live, real time. TikTok, months go by while they say and do all this stuff, which is exactly what happened in 2021. And then suddenly everybody wakes up and they see a CPI come in at, back then it was like 6 or 7%. In this upcoming, it would be maybe like we breach the fours or the fives. And then everybody kind of has a panic moment because they kind of take this lackadaisical, we'll just watch the data approach. I don't feel like they've been very aggressive against the inflation in terms of they were very aggressive against the employment part of their mandate. As soon as they got that 800,000 job revision in July, they were pushing for that, not just a 25 basis point, a 50 basis point cut in September. So one little ding to the employment part of the picture, and they were eager to cut. But when it comes to the upside of inflation, they've seemed to be very tentative in their policy response. And that suggests to me that they are probably more than okay with letting inflation run, 2.5 to 3, seeing if they can get away with it, so to speak, in terms of, if people are politically content. Um, and yeah, that's concerning to me because it very quickly can snowball from, oh, it's just kind of at 3%. It's a little higher than we'd like, but we're going to keep an eye on it and we think it's going to come back down, blah, 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 transitory, to, oh gosh, here we are again at 5 or 6%. And now we have to hike. And how high and for how long do we have to hike this time around? When we have another wave, that's going to be the tricky
I
piece.
I think you're right, and I think that their backdoor way of hiking would be to accelerate QT, but God forbid we sell the bank's assets back to them at a much at par and force them to eat some losses. I'm going to take this quick moment to plug MacroEdge.net, MacroEdge.net. Go there, sign up for the Ozone 2-week free trial at MacroEdge.net. Introducing now someone who wants to jump into the discussion, another Fox Business News guest, Ulysses Awesome. Welcome aboard, sir.
Thanks, John. Greetings from the other end of Interstate 35, Amy. How are you doing?
Good, how are you?
Good, thanks. So you had made a call a little bit ago that we shared the notion, but I'm curious to get your thoughts on what your thinking was behind it, and that home builder stocks were maybe at their peak not that long ago.
Yes, primarily it's based on the interest rate environment and the fact that they were sort of doing these stopgap measures over the last year and a half to accommodate the fact that there was higher mortgage rates than really the market was going to function at, and especially in terms of first time home buyers. When credit is tight, you see a huge pullback in that median consumer. And home builders are trying to build and sell a lot of product. They need customers. Their primary customers are first-time home buyers, are median income home buyers. There are, of course, luxury builders, but those are not the average builder. The average builder is trying to sell a large volume of average priced homes. And their customer is someone who relies on credit. And when it's hard to get credit, like it's been since the Fed was hiking rates, it's hard to find customers. So they were filling the gap privately by using their own mortgage lenders to buy rates down to, teaser rates, or they offered some kind of weird arms in some instances. They would pay your closing costs. They pulled a lot of tricks in order to not have to lower prices very much, but still get sales closed. But they also kept building and building, especially in places like the Sun Belt, Florida's, the Texas. If you saw the new home sales report from, I don't remember if it was September's or October's, but it was a recent one, and it was pretty strong. It looked decent nationally. But if you broke it down and you looked at Texas, it was bad. It's been bad in Texas for the last like 3 or 4 quarters because we built a lot of inventory, and there just aren't enough people who can afford it at these rates. And now, alongside that, this is another piece that's happening. Existing home sellers are starting to come back into the market for whatever reason, whether they just got tired of waiting, or they can't afford their insurance, or they can't afford their higher taxes, or they got called back because they had a remote job and now it's not remote, or they lost their job because, like I said, unemployment's rising. For whatever reason, we've seen existing homes in some areas, like in Texas, existing home sales. I think existing homes for sale inventory is up like 70% year over year. And that's all that inventory is piling up against the builder inventory now. So builders had this sort of golden environment in 2023 where they were the only thing on the market. There were no existing homes for sale. So builders had the market cornered and they were just buying down rates and la. It was great. Now they've got competition from existing sellers and they've got exhausted buyer pool. An exhausted buyer pool also who have been telling them that they were waiting for lower rates. And now those lower rates are probably going to materialize. So the builders have to be looking at each other thinking, gosh, what's this going to look like in 2025? Because we really need lower mortgage rates. We're running out of margin to keep buying down and offering these sort of tricks to our customers. I think it's going to be a tough, and with rates higher as well, their cost to build is also going to remain high. Their cost to borrow, and if it's like stagflation, then their cost of labor and all of that stuff that goes into their business is also going to continue to increase. So I think they're going to start to struggle pretty heavily in 25. And it doesn't mean that they're going to crash, but the run up that they had from 2020 to 2024 was like a once in a lifetime golden Goldilocks era for home builders. And they're going to sort of come back into more of a reality next year. And is their stock currently valued and priced for reality? I would say no, but I would also say neither is most of the stock market. So again, some of the stock market in general is just pricing in currency devaluation and inflation in general. So it's hard to say how much of it is fluff and how much of it is warranted. But I definitely think that we're not going to see the kind of yields for home builders that we got over the last 3 years.
I have to interject here and ask a question because I was looking at existing home sales. I was reading an article on National Mortgage Professional by Katie Jensen, and 15.5% cancellation rate for purchase contracts. Are we going to see the same thing impacting the home builders as at the same time their cost rose, which they did according to the PPI, in addition to the large houses or investors selling off properties, be it vacant land or completed homes, as they are in Florida? Are they doing the same in Texas? Are they liquidating properties at 30, 40% discounts just to get out of the markets?
We're not seeing 30 or 40% discounts in Texas at this point. There's been an increase in what I would call those at the margin desperation sales, and those have pulled comps down in some neighborhoods or areas. In terms of, what the builders are doing, I'm not seeing that. Unfortunately, one of the things I am seeing that's newer is some builders are starting to try to pivot to rentals. They're trying to take homes that they had built to be for sale for just to regular families, and they're trying to sell them off to investors, sort of off. This is kind of happening off the books. They're private deals where they're just trying to go to investors and say, hey, do you want to buy these 10 houses and turn them into rentals? They're still trying to be really creative with the inventory that they do have, but um, it's definitely a tougher environment, especially for the non-luxury builders. The luxury home builders are actually doing okay because a lot of their buyers are just buying in cash, or they're with a lot of money down, and they're a little bit more impervious to interest rates. But I think the mortgage rate piece is it's just they're just not prepared. They're not prepared for mortgage rates to stay higher for longer. And they were there's been a lot of talk. I mean, we keep hearing over and over again from the real estate industry, like there's always this next thing. Like for a while, it was just, well, the Fed just needs to start cutting rates, and the Fed cut rates, and mortgage rates went up. So then it was, this is just election drama. People have election anxiety, so they're not buying homes. At some point, people are going to wake up to the reality that prices are too high at these borrowing costs for 85% of American people. And if there is inventory on the market, you are going to have to bring your prices down to find buyers that can afford it, period. And that's why we're starting to actually finally see prices are coming down in states that have inventory, like Florida and Texas. We are seeing negative prices year over year. Finally, after, we hiked rates, in 2022, everybody thought, eventually, this is going to bring prices down. It took a while, but in these areas, we are finally starting to see that reality sort of come to life.
Do you think that the
Fantastic.
builders
Go ahead,
have
Ulysses.
to
I'm
do?
sorry.
Yeah, it's okay. Do you think that the builders are going to have to go back to live with pre-pandemic margins? That kind of the future that you're seeing?
I think so. It is slightly complicated. The one piece that's shifted because of the pandemic is that we do have a big portion of the country now locked into what might be once in a century low mortgage rates. And for how long is that going to tie up a significant chunk of existing inventory is kind of that piece that I'm less sure about, because we've never had that before. We've never had a situation where, at least in our lifetimes, where you have got a whole cohort of the population holding onto real estate that's their debt is a lower interest rate than what the inflation rate is. They're very unincentivized to sell that real estate. They're highly incentivized to just hold it as long as they can forever. And if they can't sell it, just rent it out or just leave it even sitting vacant because the debt is so cheap on it. And so as long as that piece is at play and we continue to have the strong demographics that we have for the next several years, at least while the millennials, because they're such a big generation and the boomers are still alive, these two generations are providing a lot of demand. I do think the builders will get some advantage from that. So maybe they could have slightly higher margins than before the pandemic, but I don't think they're going to have shockingly higher ones. Um, and any advantage that they do have is going to be slowly fading over time. Like I said, they had that sort of Goldilocks era already, and those advantages are already starting to slip a little bit, and they're going to continue to slip as time goes on, because as time goes on, all of those pieces go against their favor. You're going to, especially in the next, I would say about 5 years from now, when you start to see the boomer generation die off, a lot of those houses are going to come to market. Even though people say, I'm never going to sell my dad's home that has a 3% mortgage rate. Yeah, well, when you and your brother and your other sibling all fighting over what to do, you're going to sell it. You're going to sell it and you're going to divide the money. That's typically what happens with estates. So there will be a pretty large amount of inventory starting to come to market in about, I would say, 5 years or so. But up until that point, I do think builders are still going to have a decent market to work in. It's just not going to be as good as it has been.
With that being said, the home builders have taken an awful gamble buying a lot of land in the Sun Belt. Short term, that seemed like a brilliant move because the land was relatively affordable, especially during the pandemic. Could that come back to bite them as as a cost that they have to maintain for longer duration as the markets slow down, especially for the middle class?
Yes. Yes, I do think that some developers got way over their skis in terms of sort of what they thought demand was going to be. We've already seen migration is it started to slow to some of these regions, and a lot of it has to do with affordability. And all of these builders and all of these developers have kind of like these 5 to 10 year growth plans for a lot of these suburban areas or rural areas where they're buying all these plots of land, planning to build. And if we have any sort of recession, even if it's whether it's a deflationary or stagflationary, that's going to cause a huge pullback in credit using consumers, and that's going to cause a big drop in demand for homes, for new homes. And builders at some point are going to have to slow down. And if they're doing that, well, like you said, the carrying costs of the land and the taxes and the labor and all that stuff continues to go up, that's going to be a little bit of a pain for them to work through. Especially some of the smaller builders. I think a lot of the smaller builders are going to be much more vulnerable. And we already have seen the smaller builders have been much more vulnerable to these higher interest rates and to this new environment. We could see small builders go under, um, particularly if they weren't very well positioned going into this year. Um, Especially, yeah, I think that smaller builders that are more builder grade average builders are going to have a lot more of a struggle than smaller luxury builders or just larger builders in general that have a lot more access to resources and can sort of ride out different markets for longer periods of time. Um, but I definitely do think there was overzealous land grabbing in the Sun Belt over the last several years that there'll be somewhat of a reckoning with that, especially the areas that weren't well thought out, because there are parts of even in Dallas, there are regions of Dallas where there's going to be massive growth in the next decade, and it's going to be great. But there's other areas where it kind of just felt like people just started buying anything they could get their hands on, and they weren't really thinking through whether or not people were actually going to want to live there. And certainly, if the remote work piece continues to be clawed back, then you've got developers sitting on these giant rural plots of land. They plan to build this whatever subdivision. There might not be people that have high enough salaries that live in that area to buy any of those houses if we claw back remote work. So they're going to have to pivot, figure out what the heck they're going to do with that plan and that land.
I totally agree with you. And I think there's another aspect of this, another shoe to drop, and that's commercial real estate. And that's a lot of apartment building, which has been insane in Florida. We've overbuilt apartments, and that's competing with the residential market also. Are you seeing an overbuilding of apartments, condominium complexes, these new ideas of home clubs where it's like a vacation where you live and they have these spectacular overpriced condominium complexes with the pools and spas and all the other nonsense? Has that caught on in Texas like it has in Florida? And what do you think the impact will be on the banking system, especially community and local, regional, et cetera, banks, when the defaults start to accelerate, which they already have?
Yeah, I mean, they already honestly started to happen. I would say in the last year when the rates went higher, there was a massive rush to build multifamily in the Dallas area. And it started really in like 2020, 2021. And some of it was definitely warranted because there was not enough supply for how many people were coming here, and whether or not, it was immigration or legal or not, or however you want to, whatever people were coming here. A lot of people were coming here, and we did not have enough housing for them. And we did not have in certain areas enough apartments. So as these apartments were being built and delivered, they were getting occupied. And this is the first year, this year in 24, we peaked in Dallas Fort Worth. We had the highest number of deliveries of multifamily, I think, ever. And it's sort of hitting that peak right now. And we're starting to see in some of the lesser desirable areas that they're not getting the occupancy that they're hoping to get. There has been softening in rents across a lot of different submarkets. Um, and there's other submarkets that are doing fine. But I do want to point out one caution piece with the multifamily is that because of the pandemic and the delays and the hike in interest rates, new starts fall off a cliff. And so deliveries going into like 25 and 26 are going to go way, way down because we sort of went from way massive building spree to everybody pulled back and freaked out and stopped or with building, and there's a lot of things that are like started, and I don't know that they're going to be completed. We just don't know because like there were all these weird pandemic delays, and then they couldn't find labor, they couldn't find materials. These things are all just kind of out there, and you could drive by them. I mean, you can drive down and it's just out in the Dallas suburbs, you'll see these like half completed multifamily buildings. We have no idea if these things are going to go under financially, if they're going to be completed, if somebody else is going to buy it and finish it, sort of what's going to happen to it. Um, so that could, obviously be problematic for the banking system. But I also, my other concern is if a lot of these projects aren't finished, are we going to circle back and be in the same sort of that stagflationary place again a year from now with rents? Because if we're having record high deliveries this year and we're still having, nationwide shelter inflation still at 5%, what's going to happen when we have a huge drop off in deliveries next year? It could be offset somewhat by a recession. It could be offset somewhat by deportation if that actually were to happen, which I'm not convinced we're going to actually deport in large numbers. But barring that, I'm not entirely convinced that we're not going to be sort of back to neutral level of supply by 2026, in which case, I don't know that we're going to see deflation, at least in rents. I certainly, maybe we'll see a slowing of the inflation. But yeah, it's going to be interesting. It's kind of too early to tell because, like I said, there's so many of those projects out there that nobody really knows what the developers' financials look like, and if they plan to finish building the project, if they're going to go under, if they're going to sell it off. It's very murky. It's very murky. Just like the small banks, what's going on behind the scenes on their balance sheets, very murky. Nobody really knows, how good or bad of shape these banks are in right now with all these commercial real estate loans on their books, and how many of them are on the verge of failure and trouble. Are we going to have another round of kind of like Silicon Valley Bank crises in another stagflationary cycle coming up? It's certainly possible. And will the Fed bail it out again? I don't know.
I've got the same feeling you do, and it's just my gut feeling studying history that the Fed will not bail out the smaller community banks. However, I think the larger banks are pretty much insulated from any risk, especially since there's still a willingness to hold MBS for the long term. Uh, I guess I could just go with a big question right now. My belief is we're going to see a 5% 10-year sooner rather than later. That means we're going to be approaching 8% on a 30-year mortgage, and God knows what the subprime version of that will be for lower credit rated individuals. What is your opinion on the impact, not just on the home builders, but the CRE and housing market as a whole with an 8% plus 30-year mortgage rate? Something we haven't seen, by the way, folks, since the early 1980s.
I mean, right now we're looking at an absolute disaster in terms of sales volumes and mortgage application volumes and just transaction volumes. And that's been happening with 6 to 7% mortgage rates. 8% is going to be an absolute Armageddon for this industry in terms of, anything being done with credit. There's always going to be those few sales that are done in cash. Cash deals already make up a massive portion of the sales as it is, and that's been happening with just 6 to 7% rates. So 8% is going to pretty much freeze the credit market. It's going to freeze out first-time home buyers. It's going to really hamper the ability of even builders to buy down that substantially. It's one thing to buy down from a 6 to a 5. It's another thing to buy down from an 8 to a 5. I don't really think that this real estate market is prepared for 8% mortgage rates, but I also am not. I think right now, if you look at the action on the 10-year, it looks to me like it's going to peak probably close to 5, like you said. Mortgage rates then we could see mortgage rates in the 8s, but I do think then they will start to head back down going into 2025. I just don't know how far back down. Like I said, I don't think we're going to go to really low levels with mortgage rates. Like 5 or 6s is probably going to be where we end up. So the 8 is not like, I don't think we're going to hit an 8% mortgage rate this fall and just keep going up and be like 8 or 9 in the spring. I think the trajectory we would take is probably we bump up to 8, we come down a bit, and then beyond that, I'm less certain. Because I do think if we have another inflation spike in 25, I believe it would not start to be problematic until like the third quarter or so. But if that were to happen, then yeah, we could be looking at, 9% mortgage rates, 10. I mean, if they have to hike again from where they're at, or around where they're at now. And then you actually might see a very interesting psychological phenomenon with buyers where people are suddenly clamoring to buy at a 7.5% mortgage rate because they fear that they're going to 10.
That is awesome. Amy, I want to thank you so much for being our guest this hour. And to all of our listeners, we will be posting this recording by Monday. It will be on the YouTube page for MacroEdge and available at MacroEdge.net Ozone. Amy, one more time for everybody to follow you, obviously on Fox Business, and once again on X. Please highlight your handle for us. And thank you so much. You have been an enlightening guest, offering an opinion which people don't want to hear. I think we're going to have a nice recovery at the end of next year, but I think the next 7 to 8 months are going to be somewhat choppy. Please let us know where to follow you, get your opinion, and more.
You just follow me on X. I'm just here on X. This is my primary space. So,
Amy, God bless you, and thank you so much. And good luck with the kid.
He's staring at me from across the room right now. I'm making arm motions at him, like, don't talk to him.
Amy, good luck with the sick kid. Believe me.
He was waiting for the clock to tick past 2:30, and he like tiptoed up in here.
Well, Amy, thank you so much for your time, and we'll revisit this subject early next year once the new administration it becomes reality, and see where we're at.
Yeah, we'll see where we're at. I think it's going to be a very interesting first half of 25, for sure.
Amy, thank you once again. Everyone, this is MacroEdge Radio for the team here at MacroEdge.net/Ozone. Get your 2-week free trial. Don't forget to follow Amy. Show her some love for her time here, and wish her kid getting well soon. Good night, everyone.